Welcome to this latest episode of Damien's Market Update. Now, this is the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. So if you enjoy the show, do hit that like button, but also subscribe to the channel because I do these updates once a month, and also ask any questions. Now, the aim of the show is for me to give people a broad understanding of what's going on with their portfolios. It doesn't matter if you are just somebody who buys and holds, maybe a Vanguard fund. What I want to do is try and educate people so they understand what's going on in their portfolio. And that way, they are less likely to panic when things go up and down. Because when people first start investing, one of the things that they struggle with is the volatility and seeing their value of their portfolio go up and down. So I want to give people confidence in what they're doing. So if they understand what's going on, they just realize this is what happens in investment markets and they stop panicking. With all that said, then let me get on with this week's, or should I say this month's show. So last time I recorded the show at the end of August, and if you recall, there was an unexpected weakness in US jobs data in the start of August, and that actually sparked a fear of an economic slowdown in the US, which actually sent global stock markets crashing. But we did have some positive news for US retail sales and inflation data, which raised the hopes of a Goldilocks scenario in the US. So that means the market was starting to believe that the US economy was resilient enough to avoid a recession, but not too strong as to deter the US Federal Reserve from rate cuts. Now, in the rest of this video, I'll use the term the Fed to describe the US Federal Reserve because it's just easier for me. So this meant that most global stock markets actually ended August in positive territory, and that is despite the slump they had at the early start of the month. Now, the outlier was Japanese equities, and they actually ended the month down 1.16%, and that was because they were a victim of the carry trade unwind that I mentioned last time. If you want to understand what that is, go back and listen to the last episode and I explain exactly what that carry trade is. Now, interestingly, the UK had its own economic data that came out that sort of suggested a similar Goldilocks scenario in the UK, so that actually added to the attraction and resilience of UK equities. Now, as we went into that last week of August after the last show, the key event of August actually was Nvidia's Q2 earnings. So they are the chip maker in the US, and that earnings announcement is always one of the biggest potentially market moving events. Now, despite Nvidia posting record revenues, its share price actually slumped 20% at the start of September, and it has an outsized influence on US stock markets. But even though it did slump 20%, it didn't drag the wider indices down. Now, why did the share price fall 20%? Well, there were concerns over Nvidia's ability to deliver its next chip. But I won't go into details on that in this particular show. All you need to know is that there was some nervousness about the potential profitability and the market position of Nvidia going forward. At the moment, it's the market leader in the chip making industry. There were concerns that it might not be able to keep that spot. So obviously there was a wobble. People started pulling their money out of Nvidia and taking some profits because after all, the share price has rallied significantly in the last 18 months. But in the end, that, as I say, Nvidia's weakness didn't pull down the broader market, but it meant that the last week of August actually provided two more lessons to add to the 5 that I mentioned last time. And they were firstly that there are investment opportunities beyond Nvidia. I know the market has been obsessed and investors have been, but it just shows you that even though Nvidia may weaken, there are other opportunities as people rotated into other sectors. And that is why the S&P 500, for example, managed to stay elevated and didn't completely collapse. And the second thing is diversification and the importance of it. So, for example, by the end of August, the FTSE 100 actually was within 0.5% of its all-time high, while the German DAX and the Euro Stock 600, they hit all-time highs, helped by the Eurozone inflation falling to a 3-year low. Other assets also enjoyed a strong August. Gold hit an all-time high, buoyed by that risk aversion and the hope of US rate cuts. And it was a similar story for bond markets. But September has proved just as eventful as August. So the first half of September had more than a passing resemblance to August. In fact, there was a case of deja vu as US jobs data suggested that once again the US economy might be heading for a recession. This then sparked another slump in US equity markets and global stock markets by osmosis. But whereas in August, global equity markets slumped between 4% and 8% in the first part of the month before rebounding, in September the drawdowns were only about half as bad, and the subsequent rebound that we've had has pushed most global stock markets back towards positive territory as we head towards the end of the month. The laggard once again is Japanese equities. So if we're looking at the Nikkei 225, that is still down around about 2% for the month of September as I make this video, having been down as much as 8% earlier in the month. But unlike August, the big event this month was always going to be the US Federal Reserve monetary policy decision, which happened last Wednesday. Now, initially, the market had been anticipating a modest 0.25% cut from the Fed, but the narrative rapidly changed as we approached D-Day, so much so that by the time the Fed was due to announce its decision, investment markets were actually pricing in a 0.5% rate cut as the most likely outcome. Now, perhaps this ultimately paved the way for the Fed to deliver on that rare 0.5% cut to its headline interest rate and embark on a new era of policy loosening. Even so, the move still grabbed news headlines around the world. But how did the market react to this? Well, initially the news saw a wave of volatility across bond and equity markets, as you'd probably expect, which left US stock markets marginally in the red on Wednesday. But it wasn't until a day later that equity investors seemed to settle upon a new positive narrative for the large rate cut, which in turn lit a rocket under global stock markets. And now part of that positivity was probably as a result of Jerome Powell, the Fed chair, going to great lengths to explain that the Fed wasn't hitting the panic button ahead of a possible recession. He reaffirmed the market's Goldilocks narrative, and equity and bond investors didn't need telling twice, which caused stock markets to skyrocket, with the S&P 500 hitting an all-time high, which actually was the first one since July, and the Dow Jones Industrial Average did the same thing. The biggest gains were enjoyed by interest rate sensitive sectors such as tech stocks. Gold also rallied after the dollar dipped, while Treasury yields rose, and that's somewhat counterintuitive, but it was actually because they'd fallen a lot, which meant bonds had rallied ahead of the Fed rate cut. But the idea that the economy in the US was actually a little bit stronger than people had anticipated and would continue to grow saw some money move out of bonds. Elsewhere, global equity markets moved higher by osmosis on the assumption that a new era of aggressive policy loosening was now upon us and will be replicated across the globe. But interestingly, in the wake of the Fed decision, the Bank of England didn't quite stick to the plan because it actually kept the base rate at 5%. Having said that, it did cut its interest rate before the Fed did. Actually, it did it in August. The Fed took until September. Nonetheless, the market now expects the base rate in the UK to be cut far more aggressively into 2025. But the lessons of history tell us that not to place too much emphasis on what happens in the volatile days after a rate cut, particularly in the US. You should focus on the longer term. And history also tells us that the US stock market tends to perform well in the months following a rate cut, but only if the economy avoids a deeper downturn. The market is currently taking central banks at their word that this will actually be the case. But as we start to move into the final quarter of 2024, economic data releases are going to be scrutinized by investors for any suggestion that central banks have been talking up the strength of domestic economies. And if they have been, and the pace of rate cuts aren't as swift as markets are pricing in, then things could get ugly pretty quickly. And in that regard, not a lot has changed, even though the Fed has officially joined other central banks in cutting rates. And the other thing to add that's going to make the last few months of the year even spicier is the fact that we've got the US election campaign heating up, and that will inevitably start to exert its own influence on markets before and after the election date. And I tell you now, it's not all good news, but I will talk about that more next time. So that is it on Damien's market update. If you enjoyed the show, do make sure you hit that like button, but also subscribe to the channel. And as I mentioned at the start of the show, do leave any questions and comments on our YouTube channel, and I will do my best to answer them.